Good morning, everyone. We've just taken a new long position on natural gas at $3 round, and I want to go through this chart with you very quickly just to show you what's going on. This is the day chart over at the Henry Hub, the NYMEX. Right now you can see we've landed on the 20-period moving average on this day chart, and just around about this swing high over here, slightly below that one, and angling back down into this trend line and the breakout level, the triangle. Now, we've just taken a very small long position here at $3, allowing for a dip down further to 2.9 or 2.8. I'm going to show you this on my chart over at Black Bull right now because it looks ever so slightly different, and this price is delayed by 15 minutes, so let's switch across. So here's the Black Bull chart. I'm going to concentrate on the futures in this video because the spot price behaving slightly differently over at Pepperstone, and for a point of reference it's probably better to refer to the futures because everyone's trading different prices. And I suppose this is the purest form of the natural gas price. So on the Black Bull chart tracking the Henry Hub futures, we've dropped down to the swing high over here and very close to that one. We haven't quite reached the top of the triangle or the breakout level yet. And of course, we haven't reached the bottom of the ascending part of this triangle, which is even further down. I've still got this chart drawn as I've had it for quite a long time now, just shifting this arrow slightly to the right every time we move across the page sideways. So the reason I've taken this trade is that we are at this previous swing high, almost a double top, getting much closer to the optimal entry area, slightly lower, which we may or may not reach. Now, there's another reason I took the trade, and I need to switch to the 4-hour chart, and I'll show you something interesting. We've got three full stop candles in a row. This is pretty unusual for natural gas, and sometimes this indicates that we may be at a turning point. I wouldn't be surprised if we got one spike low on one 4-hour candle just to dip down into that zone where I've got that ovoid blob over here, this one over here. So maybe just touching into that order block there, the green area. Notice where the 200-period moving average is here on the 4-hour chart. That's shifting up gradually, and it'll eventually meet us in this order block too. Here's another example of these very tiny consolidation candles, followed by that spike down, wick low, followed by a spike up, forming that one down, one up reversal candle pattern. So I expect we could see something very similar to that too. I'm not sure if we'll get it or not, but possibly, and if we do, we'd probably end up getting in at the same price that we're currently at the moment, at the $3 level. The $3 level is key. We've talked about this many times, 305. So I've taken this trade because we're at the key $3 level. We've got these 3 star doji candles. We're very close to the support level that we're looking to get into. I wouldn't be surprised, as I said, if we get a sudden sharp wick down, like we've seen on many occasions before this, on this sort of pattern. The target for natural gas is back into these order blocks, back into about $3.20, $3.15, another key resistance level, another order block up here at about $3.40 to $3.50, and then perhaps, just perhaps, we'll get going much closer to $4. I don't know. We'll have to see how the season unfolds. December's generally not a particularly strong season for natural gas, despite all the common misperceptions, I suppose. Let's go back to the day chart. So I think this pretty much tells the story. I'm going to put my new long position in here. We've got one from slightly higher up. Both of these are very small tranches, and I'll be looking to add either down or up, looking for a move back up to about 3.5 and then 3.7 maybe, 3.8. We talked about 3.8 up here being a pretty key level because if I switch this to the weekly chart, you'll find it's also where the 200-week moving average is here on natural gas. Difficult to see because I've covered it up with my green line, but there it is there, the purple line, the 200-week moving average, and that's my target for natural gas. Be very careful once we get there. The 200 MA, pretty significant resistance level just above us. Just for completion's sake, here's the continuous or spot price over at Pepperstone. You can see we've come down to the 20-period moving average here on the day chart, and also very close to this previous swing high. If we see the futures moving down another 15 or 20 cents, this will probably follow suit. So we're currently trading at 2.94, and that would take us down to 2.84, which is exactly the top of this previous swing high. Before finishing off, I want to look at the COT report and just show you over here that on the seasonal chart, we're still well below the seasonal average in terms of price. That's the last 5 years. And going across the commitment of traders, the commercial 665 long, 513 short, pretty much balanced, slightly to the long side, perhaps expecting the market to go down, and the additions and subtractions pretty much the same on both sides, minus 46 and minus 40. The producers 248 long, 272 short, so pretty evenly balanced as well, as are the subtractions, in both cases subtractions, minus 28, minus 25. So in a bit of a limbo, I suppose, right now, at this very key $3 level. The managed money, hedge funds, institutions, banks, and perhaps larger retail traders, 177 long, 238 short, so angled towards the short side, adding a heap more onto the short side. Remember, this report's 8 days old already, as at November the 26th, so these will have changed when we get the next update. The non-commercials, 215 long and 369 short, very heavily weighted to the short side and adding a little bit more to the short side too. Are they expecting this to go long? I don't know. These are more likely to be hedgers than actual traders, so let's see. The swap dealers, on the other hand, different story, 210 long, only 35 short, so that perhaps they're expecting this market to go down, adding fractionally more to the short side. And then other reportables, perhaps some of the retail traders, 38 long, 130 short. So the whole herd in the retail side moving to the short side. So if anyone's wrong, it's normally the retail traders, and because they're so heavily short, perhaps that indicates that this market is not as short as it might look currently. So key takeaway, the commercials, producers and the hedgers all in a bit of a limbo right now, fairly equally balanced long and short, whereas the retail traders, the other reportables, very heavily to the short side, and managed money also short, but not as much as the retail traders most probably. Have a great trading day. I'll see you in the next video.
Not gas kings, we trade with grace. It will make us smile, lights up the place. Market swing, but we hold our base. Double bottom strong, we're in the chase. Come on, click and clack that online race. Sharks go wild.